Well, good afternoon, everyone. Thank you for joining us today for our webinar on credit scores. My name is Josh Antis. I'm in the Community Relations Department here at California Coast Credit Union. And I just want to welcome everyone. Hope everyone's doing well and happy Wednesday. So a few things to dive into before we get started. I usually have everyone placed on mute, but we kind of have, it's not the largest group we've had before, but it's not the smallest. So I think what we'll do is we'll kind of open it up so that if you do want to unmute to ask a question, you definitely can do so as we go or towards the end of today's presentation. Usually we have everyone on mute, but we'll try something new today. And also want to mention that there is what I call it, an evaluation form, I guess, or like a survey that you'll receive at the end of today's presentation as well. That survey, if you go ahead and answer, I think it's like 7 questions, it'll take you a couple minutes. That will enter you into a drawing for a $50 Amazon gift card.
Wow.
So no, Tara Lynn, you can't take part in that. So please take the time to fill that out. It's kind of our way of getting your feedback so we can continue to improve our webinars and all of our different programs as we go. You'll also have the opportunity to fill out that survey. There's going to be an email that comes to your inbox after today's session as well. So if you aren't able to fill it out on the spot today, you'll have a chance to do so when you receive the follow-up email thanking you for joining us today. So that'll be there as well. And then before we get started as well, I just want to mention that we have a lot of great financial tools and resources available for you as City of San Diego employees. We are in our 6th year now as the preferred financial partner for the City of San Diego. And we just renewed another 5-year agreement. We're really excited about that. And we have a portal that actually has all kinds of different resources for you. So I'm going to go ahead and put in the chat the link that you can go to access all of that. One thing that I do want to mention is our Enrich platform. So we have, it's a platform that is basically an educational resource or a place where you can go to get tools, tips, learn all kinds of things about any financial topics that you can think of, whether it's budgeting, credit scores, debt, loans, retirement investing, on it. The list goes on and on. There's thousands of resources there in the form of videos and articles and tools and courses. You can even take a quick assessment and it'll put together materials that are based on your needs and kind of personalize it for you. And it's all free, all something that we offer to you as employees of the city. So go and check that out. Again, I'll put the link in the chat shortly so you can see that and take a look. And so I think with that, I'll go ahead and turn things over now to Tara Lynn Rose. She's the manager of our financial fitness coaching department and kind of our main presenter. If you've joined us before, you've probably seen her present before. But she is a really great presenter of wealth of knowledge. And so with that, I'll turn it over to Tara Lynn and we'll kick things off.
Thank you so much. One of my favorite topics to talk about, credit scores. That's what we're going to be talking about today and trying to take the mystery out of credit scores. We're coming up on Halloween. It's a great month to do this. There's so much misinformation out there that we feel this is a really important topic for our members, for our preferred partners to understand what goes into a credit score. And this is always start off with a bang when it doesn't work. There we go. What affects your score and how to manage your credit so you can get into those high numbers where you get approved, all the lenders are falling all over themselves to loan money to you. That's where we want to get you to. So we're going to first talk about what a credit score is. We have this wonderful definition on here, this statistically derived numeric expression of a person's credit worthiness that is used by lenders to determine the likelihood that a person will repay his or her debt. It's a really long explanation. Basically, what it means to us is we use your past history on how you've paid debts in the past to determine what our credit risk is today if I loan money to you. Based on what you've done before, how likely am I as a lender to get my money back if I loan it to you? So that's what that credit score is all about. It's not for you, it's for us as lenders so that we can make good lending decisions and get our money back so we can turn around and loan it out to somebody else. So I have this question on here. The main credit bureau that lenders use is VantageScore. Is this true or false? So in the chat, Just want to throw in what if you think Vantage Score is the main credit bureau that lenders use. Is that Vantage Score, is that true or false? TRF, true or false? Throw that in the chat. Let us know what you think. This is one of those things that is out there that we want people to understand what's going on. And you guys, if you don't know the answer, look in the chat. They've got it all right. Vantage Score is a system that was kind of developed by the three main credit bureaus, which is TransUnion, Equifax, and Experian. And they kind of put this so that you guys can get an estimation of what your score is. But it's not the main scoring system that we use. 90 to 95% of us use the FICO scoring system. So these are the three main credit bureaus that kind of compile all of your information together, put it on a nice, neat report, and sell it back to us as lenders. And it's just a review of how you handled money that you owe, money that you borrowed, and that puts it on, we have to buy it. We as lenders buy one of these reports, or all three of them, we're doing a mortgage, to make our lending decisions. Okay, so they're all, it's like Pepsi and Coke. They're the same thing, but they're putting it in a different type of report. So when you apply for a loan, your lender's going to pull probably one of these three main credit bureaus. If you apply at CalCoast, we use the Experian report. Equifax, TransUnion seems to be what landlords like to use, so it is good to look at that one. So we want to know what's on all three credit bureaus. We do not have to report our information to any of these, let alone all three. So you might find information on one credit report that's not on the other. So you definitely want to look at all three of your credit bureaus. What is on that credit report? You're going to see information reported from financial institutions like banks or credit unions. If you've got a car loan or a credit card or a personal loan, or retail stores. Maybe you got a credit card at Walmart or JCPenney or Macy's. They usually report that information to the credit bureaus. If you have any collection accounts or medical bills that you didn't get paid, that typically will get reported to the credit bureaus. And public agencies like the courts, if you filed bankruptcy or you have a judgment against you. That's information that's getting reported that we're going to look at to make that lending decision today. So why does this matter for you to understand what's going on with your credit report? Your credit is used for so many reasons now. It's not just a loan. There are certain jobs that if you don't have a good credit score, you're not going to get that job. I've had someone come in who wants to get a job in law enforcement, didn't have a good score. We had to improve that score so they could get that job that they were looking for. If you're going to handle more than $10,000 in cash, they want to look at your credit risk because they found that people with low credit scores are more tempted sometimes. So we want to make sure that we have that good credit score so that you can get that job you're looking for, so that you can rent a house, so you can lease or buy a car or a home. They're even pulled sometimes just to get your own cell phone or your own SDG&E. They're going to pull that credit to see how you've handled things in the past because you're paying for the service. They want to make sure that you're going to pay them. Life insurance policies, auto insurance policies, they actually do pull credit. And then also for pre-approvals. So this is something that California Coast Credit Union does occasionally. We get an estimated score and we'll do pre-approvals for you for cars and credit cards based on that credit score. Do we feel like we're going to get our money back? We want to loan money to you. Take advantage of that. Okay, so here's a really good question. Too many addresses on my credit report will drop my score. Is this true or false? What do you guys think? Throw that in the chat. Too many addresses on my credit report will drop my score. Is that true or false? And you don't have to worry. Not everybody's going to see this. This is just me, just our people at people at CalCoast. So this is actually not true. This is false. Too many addresses. So we are going to see the addresses. So anytime you apply and that credit report is pulled for review, that credit report is going to keep a record of that address. This is how we as lenders help fight ID theft, right? If someone comes in and is applying for a car loan, they say they lived at their house or been there for 10 years and the address doesn't show up on the credit report, that should be a red flag for us, that maybe there's some ID theft going on. It may just mean you haven't applied for anything at that address in the past 10 years. We don't know, but it does not impact your score. And thank goodness, because I've probably moved every 2 years, for the past 20 years. that I'm so glad addresses do not impact my score. We do see it as a lender, and we do want to might ask some questions, because when you keep moving, there's all those fees, and sometimes that can be affecting the lending decision, but it's not going to affect your score. Okay, that's a good one. So here's a really good, a slide that shows you why it's important to have a good credit score. So we have John and Jane. Credit score, John 620, Jane 750. So 750 and above is when you're going to get the best rates on everything. So the top score that you can get is 850. 750 and above is your A+ platinum. And then 700 is still pretty good. 675, that's kind of our third tier. But 750 and above is what we want to get you to. So this person's going to buy a car, and John has a lower credit score, so he's a higher risk. There's a possibility, based on how he's handled his debts in the past, that he's not going to pay me back. So I'm going to charge him a higher interest rate to get some of my money back, just in case he decides to not pay that loan back anymore. Jane's got a really good credit score, has handled all of her credit in the past perfectly, good payment history. She's got 3.88% on the rate for her loan. Monthly payment, look at the difference. 318 compared to 276, because you have a poor credit score. The total payments, look how much it's costing you. So having a good credit score is going to save Jane over $2,500. And I'm sorry, I can think of a lot better things to spend $2,500 on than interest, because I don't have a good credit score. So we're going to go over how to improve that score. I want to talk a little bit about the FICO score system by itself. So this is a company established in 1956 that established this scoring system. And this is the one that is used by 90 to 95% of the financial institutions. It's what CalCoast uses. We use the Experian report. We use the FICO scoring system. And again, this just assigns points to things that you've done with your debts in the past and creates this score system. One of the things that people don't know, which I think is really important to understand, is that within the FICO scoring system, there are different models. It's like having a 2017 Toyota Camry versus a 2021 Toyota Camry. It's the same car, it does the same thing, point A to point B, but the newer one has heated seats and GPS. It doesn't change the function of that car, which is to get you from point A to point B. Same thing within FICO. They come out with different models every few years. We as lenders have to buy the new model if we want to use that information. So if I am using a FICO model and I'm making good lending decisions and they come out with a new model, I might not buy the new one right away. So the FICO 9 came out in 2014. California Coast didn't buy it until 2019 because we were making good lending decisions with a FICO 8 model. We have no reason to shell the money out to buy the new one. Then finally it's like, okay, it's time to start using the new one. We bought it 2019. There's even a newer model, the FICO 10 that came out last year. We're probably not going to buy it anytime soon. So the FICO 9 has a couple of different things, that heated seats and GPS, that help, I think it helps consumers a little bit more. If you have any medical collection accounts, they don't hurt your score as much as other types of third-party collection, because we found as lenders, people who have maybe $100 medical collection for a copay that they didn't get the bill for are still paying their car loans and still paying their credit cards. So having this medical collection isn't as good of an indicator of credit risk to us as maybe a third-party collection for a Capital One credit card, right? So medical collections don't hurt you as much if the lender's using the FICO 9 model. The other one that's really interesting is the collection accounts. Paid collection accounts will stop hurting your score as soon as it's reported with a zero balance, which is really beneficial for consumers, right? If you have a 5-year-old collection account and it's going to fall off your report in 2 years, so they only stay on for 7 years, a lot of people were like, I'll just let it go, I'm not going to pay it. So we got unpaid accounts. Well, now you have this benefit that if you pay it, it stops hurting your score right away. So if you're looking at buying a car, buying a house, we can get this, stop affecting your score, get that score up, 20, 30 points. That gives you more of an incentive as a consumer to pay that third-party collection account. And now we as lenders are getting some of our money back. So it's kind of a benefit, a win-win for everybody. The third one, rental payments. So this one, it's nice, but honestly, I've been doing this for about 30 years. I've only seen rental history like 3 times maybe on a credit report. So if your landlord reports your rent payments to the credit bureaus, and if the lender is pulling that credit report, and if the lender is using FICO 9, then rental history will actually help benefit that credit score with that payment history. That's a lot of ifs, and I haven't seen it very often, but it is part of the FICO 9 model. So I just want you to understand that you could have the exact same report on the exact same day. 2 different lenders are going to have 2 different FICO scores because one's using the FICO 8 model and one's using the FICO 9 model. And then if that isn't even enough, within the FICO 9 model, there are different types. Like there's a FICO 9 auto, there's a FICO 9 mortgage, there's a FICO 9 bank card that look at different criteria. If you're looking for the FICO 9 auto, they're looking at mostly how you've handled car loans in the past. And so it's going to be a different score for the auto FICO 9. So all kinds of things going on that can impact what that score looks like. So understand different models. So the 3 questions you want to ask: which credit report is being used to make my lending decisions? Is it TransUnion, Equifax, or Experian? Which scoring system, mostly FICO, but ask, and then which model within that FICO scoring system are they using? Okay, lots of great questions. So now we're going to go how the FICO score is broken down, because this is the one that we all use. This is the one that you really need to understand. And it's payment history, the most important part, 35% of your score, 30% balances, 15% length of credit history, 10% new credit, and the other factors is kind of a variety of things. So we're going to talk about each one of these and go over the tips and tricks so you can understand and use this to play the credit game. That's what I call this, only this is way better than Pokemon Go or Pac-Man, because this really has an impact on your life. When I can get to that higher score, it's going to help me in my future. Okay, so payment history, the single most important part, 35% of my credit score based on how you've repaid your debts. And it's really super black and white in this category. So you don't get more points for a bigger payment. You don't get more points for making more than the minimum in this category. You don't get more points for making 5 payments in a month. All we're looking at is, did you make your minimum payment based on the contract that you signed with that lender, yes or no? If you make it on time, you get a green check mark, great. If you're past due, and we're not talking 15, 20 days late, we're talking if you're 30 days past due, that does get reported to the credit bureaus. And if you have a 700 credit score, you're going to lose 40 points in your score the next month as soon as it's reported. 40 points. It's going to take 2 years of regular on-time payments to get those points back. And that is going to stay on your report for 7 long years. 7 years. So even if you have a late payment and you now made it all on time and it's been 3 years since you've had any late payments, if I as a lender pull your credit report and I see that late payment 3 years ago, it's not hurting your score anymore because only what you've done in 2 years is impacting your score. But I'm going to ask you questions about why you were late. So it can impact lending decisions even after it's no longer hurting your score. Because I want to make sure that whatever caused that late payment is not going to affect me if I loan money to you today, right? If I have $20,000 for a car loan and I have a choice between someone who's always on time and someone who has a couple of late payments, if you think about this from the point of view of the lender, which is the whole point of the scoring system, if you're 30 days past due, I have to pay somebody to call you to find out when you're going to get that payment in. I am sending out letters and paying postage. Hey, you're late. Did you know? Can you get your payment in? So it's costing me money when you're past due. So if I have this choice, I'm going to go to someone who's never late because I don't want to have to chase people down to get those payments back. It's the biggest indicator of my credit risk if you're 30 days past due. Now, only one, we're going to recover from it. If I've got 2, it's actually even a bigger hit. If I'm 60 days past due, it's a 100-point drop in that 700 credit score. It's bad. We don't like to see that because that means that those lenders are not getting their money back. So this is the most important part of your score. Again, only what you've done in 2 years is impacting that score. And what you've done more recently is going to impact your score more. Because if I am pulling your report to look at it to make a decision, I am more worried about what you did last month than what you did a year ago, than what you did 2 years ago. And 3 years ago, I mean, goodness, how much has changed in the past 3 years. It doesn't really, people get married, get divorced, have kids, change jobs, retire. So much changes that we don't want to make our lending decisions on that score based on what you did 3 years ago. So what you've done 2 years, most recent history affects more. So the trick here is if I have a credit card and my minimum payment is the balance or $25, whichever is greater, if I charge $1, say I haven't used that credit card in a year and I want to get some more points, I'm going to go use that credit card and pay it off right away. So I have a recent payment reported, and that's going to bump my score, if I haven't used it in a year, about 3 to 5 points. And if I've got 2 or 3 credit cards that I haven't used in a while, I'm going to use all 3 of them, charge $1, pay it off. I'm going to get 3 payments reported, which is an even better way for me to look at how you've handled your debt as a creditor, right? If you have 3 payments, that's better than 1 payment. If I've got 10 payments, that's even better, as long as we have a zero balance on those credit cards, which we'll talk about in the next category. So this is the trick that I did when I just bought a car in July. I got a wonderful 2017 Kia Optima plug-in hybrid, cut my gas in half, and it got heated seats, best thing ever. But I have 10 credit cards that I've had for a really long time. I went and used all of them, and I charged like $5 on each one of them, paid it off. I had 10 payments reported with a zero balance. That makes me look really good and bumped me about 15 points on my credit score. Not that I needed it, but just, it's a trick to make that score look even better. Okay. Any questions in this category? You can chat or unmute. It's one of my favorite ones. All right. Next category is my favorite one. This is the tricky one. So this is balances. 30% of my credit score is almost as important as the payment history. 30% of my credit score is based on balances. And we're looking at overall balances. So if I have 10 credit cards with balances and 10 student loans and a car loan and a mortgage and personal loans, lenders are like, okay, whoa, that's a lot. And it's going to impact my score negatively. The other really important part of this is the balance to limit ratio on my credit cards. So this has changed a lot over the years with the older models. If you were less than 50% overall, you were fine. With the FICO 9, FICO 8, FICO 9, you need to have less than 30% of that limit on every single individual credit card, right? So if I've got $1,000 limit, you never want to carry balance higher than 300, because as soon as you go over that 300, it's costing you like 15 to 20 points. I had one person who had just one credit card and they were using it and they were being reported as higher than that 30% balance to limit ratio. Their score went up 30 points by paying that down completely. So 30 points for one credit card. The more cards you have, obviously kind of diffuses that. But just understand that that balance to limit ratio is really, really important. I also, this is one of those mysteries, those misconceptions. You do not have to carry a balance or have a balance on a credit card to have a credit score. I'm going to say that again because this comes up all of the time in my one-on-ones. You do not have to have a balance on your credit cards. However, you have to use your credit cards to create recent positive payment history so that I, as a lender, can see how you're handling their debt. If you pay off a credit card and stop using it, that payment history gets older and older, your score is going to go down, right? So I think this is where people got sucked into that. Like their score started going down. They put a balance on their credit card. They had a payment. Their score went back up and they thought, oh, I should have a balance. No, I'm here to tell you, even a $10 balance on a $10,000 credit card limit is going to cost you points. Any balance that gets reported to the credit bureaus on a credit card is telling lenders that you charged more than you could afford to pay off. So it is any balance is going to cost you points. So ideally, what you want to do is use a credit card, pay it off in full, and have a zero balance. So payment 35%, a zero balance on my limit, 100% of that available, 30% of my credit score. Okay, So the trick here, and this is where we get people all the time, is that your score is based on the information that gets reported to the credit bureaus, right? And every lender reports on a different day. So if I've got 30 credit cards, I could have a different lender reporting every single day and have a different score every single day. The other thing is we only report one day a month, whatever day that is. We don't report every single day, just one day. So CalCoast, we report on the 1st. All of our credit cards are due on the 25th, right? So if I pay off my credit card in full on the 25th, I'm like, oh, I'm doing so good with my credit. I paid it off in full. But then I charge something on the 29th, that balance gets reported on the 1st. And even if I pay it off on the 2nd, it's not going to get reported until the next month on the 1st. So that reporting date is so important for you to understand with all of your credit cards. And we're going to give you some free resources and show you where to find that information. What I did with my credit cards is I got a black Sharpie. I wrote the due date / the reporting date on the front of every single credit card that I have, so that I always have that information. And I know if I charge something on the 29th, I need to pay it off immediately to make sure I have that zero balance. And you can pay it off right away. So I would go charge, I have a credit card I get points on. I'll go to Costco, load up my credit card, sit down and pay off what I just charged. I don't have to wait. I use my bill pay. I pay it off right away. I know what I charged, so that I always have a zero balance when it gets reported. So that's the trick here. Know the reporting date. Know the due date too, pay it on time, but know the reporting date so that you have a zero balance the day before it reports. CalCoast reports at 4:00 in the morning on the 1st. There's no way you're getting in on time to get that balance paid off. You'd have to wait another 30 days until it reports again. So the day before your creditor reports, have a zero balance. I have Netflix that goes to one credit card. I pay it off in full. I have a cell phone gets charged to another credit card, pay that off in full. I use that third one for gas and groceries. I pay that off in full. I always have 3 payments reported. I always have a zero balance. And those credit cards just get older and older. That's going to help impact my credit score. You're going to see on here, do not close your card. So this is it's kind of yes and no. If you close your credit card, you are no longer going to have that balance availability, which isn't going to help your credit score. You also can't use it to make recent payments, which is 35% of my credit score. The other part is going here to length of credit history. 15% of my credit score is based on my length of credit history, right? And if I close a credit card, the credit bureaus only keep 10 years worth of positive information from the time a debt is paid off or closed. If you had any late payments, it only stays on there for 7 years. So if I close my credit card that I've had for 25 years, 10 years, it drops off my report like it never happened. I'm going to lose 35 years worth of payment history. And that's impacting 15% of my credit score. So don't close a credit card you've had the longest. That's establishing that super duper long length of credit history, because any other fixed loan, the mortgage, the student loans, the car loans, you pay those off. Those are going to fall off your credit report eventually if it's any type of installment loan. So the credit card really is what's going to be establishing that long-term length of credit history. We're also looking at average length of credit history. So when you open a lot of loans in a short period of time, like everyone's like, oh, you get $100 back if you apply for this credit card, and oh, you'll get 25% off if you apply for this credit card, and you get the car loan. Like all of those loans is a lot of information in a short period of time. So what we look at as lenders is that length of credit history, your average length of credit history. If you open a lot of loans in a short period of time, that does impact you in this category. Any questions so far? The balance one is my favorite. That reporting date is always like, oh. Okay, let's talk about hits. This is new credit, 10% of my credit score, and this is based on your requests and also any new loans that you get on your credit report that are reported. So we look at hard hit inquiries. That's anytime your full credit report is pulled, that's a hard hit inquiry. So every hard hit inquiry is costing you 3 to 5 points on that credit system. So if you apply at CalCoast, we pull up a copy of your Experian report. Experian keeps a record of that request for 2 years. These hard hits stay on for 2 years, and the Experian score is going to go down 3 to 5 points. We didn't ask for TransUnion or Equifax, so those ones aren't impacted. And out here on the West Coast, Experian seems to be the report that we lenders like to use. So just look at that report, look at how many hard hits are on there. If you have more than 3 hard hits within 6 months or more than 6 within 12 months, it's actually an additional hit on your credit score because it's a red flag for us as lenders, right? If you're out there applying for 10 credit cards in the past 6 months, that's what if you got approved for all of those? Those are a lot of new debts to have in a short period of time. Or maybe you got denied for all of those. And then I'm going to take a closer look at your application to see why it got denied. What's the red flag there? Maybe you haven't been at your job long enough. Maybe you owe too much to other lenders. There's all kinds of reasons why a loan might be denied, not just the credit score. So this hard hit, if you have a lot in a short period of time, it's a red flag to us. And it's a hard hit. It's going to affect your credit score. There are 3 exceptions to that additional. You're still losing 3 to 5 points for each hard hit. But if I go to dealership and they send it out to 10 different lenders to get me the best rate, all of those lenders do a hard hit, I'm going to lose 3 to 5 points for each one. But this additional 3 within 6 or 6 within 12 is not impacted because we know you're not trying to buy 10 cars. We get that. We know you're not trying to buy 10 houses. We get that. So we understand you got about 45 days with the FICO 9 and FICO 10 to do some shopping. We still recommend, because you are losing points for each hard hit, go get a pre-approval from your bank or credit union. Take that with you. Don't let the dealerships run their credit unless they can tell you with your score, they can give you 0% because they can't beat 0%. But I would recommend getting a pre-approval, taking that with you so that you don't have your credit pulled over and over. Soft hit inquiries are when you pull your own credit. You can look at your credit report 20 times a day. It does not impact your score, okay? We have what we call the pre-approvals, like 3 times a year. We'll do a soft hit and just get your score so that we can do those pre-approvals that we talked about earlier. Those don't hurt your score. And so you'll see them on your report. It'll say these ones impact your score, these ones don't. Just gives you an idea of who's looking at your score. So you can see, and you can also opt out if you want to. Like if I have a high risk lender who keeps looking at my credit, like stop looking because I'm not going to go with you. So hard hits, soft hits, and then also understanding that anytime you get a new loan, whatever type of loan it is, whether it's a car loan or a credit card or a mortgage or a student loan, those all get reported to the credit bureaus. And when you have a new debt, it's too new for us to calculate your risk yet on that. So you're going to see your score go down anytime you get a new loan. 1, you've lost points for the hard hit. 2, you've lowered your average length of credit history. 3, if it's a car loan, there's a new balance that's reported to the credit bureaus. That's 30% of my credit score. And until you have 6 payments reported, you're not getting credit for the payment history. So kind of the guideline here, don't apply for things more than once every 6 months. That way you stay within the hard hit guidelines. You get credit for that loan payment history before you apply for something else. It's like 20 to 30 points that you get back once you have 6 payments reported. So just don't apply for things once every 6 months, more than that, okay? And then you'll stay within all of that. The last 10% is types of debts and types of debtors, so variety. We want to see how you handle more than just a credit card. We want to see how you handle more than just a car loan, right? If you only have one loan, that doesn't give me as a lender a lot of information to base a current lending decision upon, right? So if all I have is a car loan, if you don't make your car loan payment, you lose your car. There's a huge consequence to that. Well, if you take that credit card and buy tickets to Tahiti and come back and don't pay your payment, I can't take the trip back. So that unsecured credit card, we want to see that type of debt payment. People who say you don't have to have a credit card, yeah, you do. Because 1, if I don't have any revolving credit cards, my length of credit history is never going to grow because everything else is going to get paid off, right? 2, if I don't have a revolving type of credit card, I don't have a balance to limit availability to work my magic by using and paying it off. So you kind of do. And I actually recommend 3 credit cards always, because if you ever want to buy a house, we want to see at least 3 trade lines with a year's worth of payment history before we give you $600,000. We want to see more information. And if I've got a car loan, that payment's usually a little bit higher. The loan amount's a little bit higher. So I do want to see how you handle that. And then we've got the student loans and the personal loans and the mortgage loans and all the different types of debts that are out there. If you have more than just one type, that gives me more information to make that decision on. The last part is the types of debt. So it's not a huge difference, but it does impact a little bit. And this is who you borrow from. There's a lot of high risk lenders out there who, you know, the people on the corner who say no credit, bad credit, no problem. I know you've seen them. They'll give you a car loan, even if you have a 400 credit score, they'll give you a car loan, but they'll charge you 20% for the privilege of borrowing their money, right? Because you're a higher risk. So when you borrow from a high risk lender, it's because you're a risk. You definitely wouldn't pay 20% for a car loan if you could get a car loan from your credit union. We're at like 3%, right? There's the choice with that low credit score. 20%, if I get my score up, 3%, we'd go there if you could. So if you have high risk lenders on your credit report, it's because you are a risk. And that's what your score is all about to us. So having high risk lenders, you're not getting as many points as if you borrowed from reputable lenders. This is the only time that I will recommend people close out their oldest credit cards, as if it's a high risk credit card. And I will say, we'll get you some good credit cards after we've built up your score. We'll get you some good credit cards. Then we will close that one, because now we're looking at the long-term benefit on my credit report and getting those high risk lenders off. So any questions on anything that we've talked about so far about what's impacting that FICO score? As I know, there's a lot of information. We are going to have handouts. You will have access to this recording. There are notes on the slides. So you're going to have all this information and a lot of really great handouts. So just going to kind of move on then. Okay. So here's a pop quiz. What doesn't impact your credit score? Annual income, length of credit history, addresses, all of the above, or A and C? This is a trick one. See if you guys got this one. So in the chat, what doesn't impact your credit score? We went over the 5 things that impact the credit score. What do you see on here that doesn't impact your credit score? So we're half right. So it's actually E. Annual income does not impact your credit score. It does impact the lending decision. You know, we're going to like, can you afford this new loan? But it doesn't impact your score. It's just those 5 things: payment history, balances, the length of credit history, the hard hits and increase in new credit, and the variety of debt. Those are the only 5 things that are going to impact that credit score. So the actual answer is A and C. Addresses, we talked about, does not impact the score, and your income does not impact your score as well. Someone who makes $1,000 a month can have a good credit score if they have a credit card they use and pay off, use and pay off, use and pay off. They can have a good credit score because they're repaying their debt even though they don't have a lot of money. That's really all we care about, is, are you going to give us our money back? That's really all we care about. That's the whole point of the scoring system, is, are we going to get our money back? And it doesn't matter how much money you make. What is our risk with that? Okay. I have a question. What is a good age? Go ahead.
Oh, yeah. So I was going to say, there's questions in the chat, Carolyn, if you want to take a look.
I see the one. What is a good age to start a person on credit? 18 is the earliest that you can, because we're building that length of credit history. We want to get started as soon as we can. You can't get it done before 18 because you actually are signing a legal contract with a creditor, and before the age of 18, you can't do that. So 18, as soon as they're able to, we want to get you started on building that credit so we can grow that length of credit history. Was there another question that I missed?
Yeah, what credit cards do you recommend?
I like the ones where you get points back or you get cash back, because if we're using and paying off the credit cards in full every month, now I'm using the creditors. They're not using me, right? So if I get 3% back on gas and groceries and I pay it off immediately, I'm not paying any interest. And they're paying me, I get about $50 a month, $600 a year, because I use those credit cards that get points back, and I'm not paying any interest because I paid off in full. So I like the credit cards that you can actually get money back or points back, depending on what you do. Two of the places I like to look for credit cards is NerdWallet, NERDWALLET, and the other one is comparecards.com. So nerdwallet.com, comparecards.com. They can go in, they don't show you the credit unions, so I would look individually at credit unions. We typically have really good rates on those because we are a nonprofit organization. We're here to help you guys. So typically you're going to get the better rates through the credit union. We do have a cashback credit card. But look at, there's some that do travel. There's some that give you money to go eat out. There's some that, so you kind of want to look at how you use those credit cards and make sure that you don't get one that you're tempted to charge and not pay off in full. So I like the credit cards that get points back. Any others? I have a question about adding a minor daughter to my account as additional user. Typically, again, they can't do that until they're 18 years old, because when they're using that credit card, they can use that credit card. And when they use that credit card and they sign the receipt, that is a contract with an obligation to pay. And again, until they're 18, they really can't do that. So if your creditor allows it and they don't ask for the birth date, but typically until you're 18, you can't add a minor onto a credit card. But adding an additional user as an authorized user does help. So I did that with one of my daughters. Their score went up 40 points from a credit card that I've had for a while. I use and pay off in full every month. So that history shows up on your credit report, showed up on her credit report and helped her score. Not as much as it were actually her joint obligation, but adding someone as authorized user is a great way to start off building a score, as long as that person's handling that credit card well. Like if you have late payments, that's going to hurt that other person's score too. So that's really good. A good question. Does terminating your rental lease affect your credit score? If they report it, so that's the part where it's your score is based on what gets reported to the credit bureaus. So if you terminate your rental lease and you owe money and you don't pay it back and they report that to the credit bureaus, that will impact your score. It just depends on whether or not they report it. Great questions, guys. This is why I love this. There's so much information out there, so many questions, and this is a great webinar to dispel some of the mystery. Okay, so I want you to check your credit reports often. We have this free resource, annualcreditreport.com. It's the only federally backed website where you get one free copy of your credit report. It used to be every 12 months. They're now doing it more often because of COVID. But you get one free copy. You don't get a score. You just get the report. You have to go in each time individually. I used to tell people, get TransUnion in January, go get Equifax 4 months later, and get the other one 4 months later, so you keep track all year long. However, we have these free resources you can sign up for. They have apps and you can do it on your computer as well. Credit Karma will give you Equifax and TransUnion reports. They give you a Vantage score, so it's not the FICO score, but it's updated every single day. So this is a really great resource because you get to see what's on your actual Equifax and TransUnion reports and get an estimated score so you can see how your actions are impacting your score on a daily basis. It's really, really cool. Experian.com directly from the source will now give you a free Experian report, and they give you a FICO score. The bad news is it's an older model, so it's a FICO 8 scoring system, and they only update every 30 days. So if you open this up on the 15th, CalCoast reports on the 1st, you're still not going to see it. It's reported and it's impacting your score, but you're not going to see it on Experian.com until the data refreshes every 30 days. So I have both of these, and they notify me if there's any changes, but I get access to all 3 credit reports, so I always know what's on them. And I love Credit Karma because I can see, again, how my actions are impacting on a daily basis. So great resources, completely free to sign up. They will try to reel you in to their monthly fee one. Experian, you have to scroll down once you sign up to keep my current membership. That's free. But I do recommend that you sign up for these, completely free, no credit card required. If they're asking you for a credit card, go back. You're in the wrong place. Credit Karma, Experian, great resources. Okay, so just getting started building credit. What's our time limit? I always talk too long. No score, I have no score. Maybe I filed bankruptcy and it's been a while, or maybe I'm new, 18 years old, have no credit. What are ways that I can get a credit score so I can start building that? So we've already talked a little bit about authorized user. Adding someone as an authorized user will put that trade lines information on the authorized user's credit reports, whatever it gets reported to. So it's a really quick, easy way. Again, has to be a credit card that's handled well. Don't get added as authorized user to someone who has late payments or is maxed out on their credit card, because that hurts you too. Experian, which is the one that CalCoast uses, Experian has a free service called Experian Boost. It's free, it's instantaneous, and what you do is you allow Experian to scan your either bank account or credit card account for payments to streaming services or utilities. So cell phone, water bill, SDG&E, Netflix, Disney, Hulu. If you pay any of those and you give Experian authorization to look at your payment history, they will put that history on your Experian report. I saw a person with 5 accounts that their score went up 40 points. So it's a really great instantaneous free service, but only helps Experian, but that is who CalCoast uses. The other way of starting, if you don't have someone who will do authorized user, if you don't, maybe you're renting a room and you're not paying for any of those utilities or streaming services, you can do what's called a share secured installment loan. And this is really hard to explain. We basically put $300 in a savings account and we place a hold on it. So you can't withdraw the funds. That's the collateral for the $300 loan that we're going to do. So a $300 savings, we hold it. We do a $300 loan, deposit $300 into that savings. So I've got a $600 balance in my savings, 300 of it on hold as collateral. We set an automatic transfer, paying back that share secured installment loan, so $300 for 12 months, payments about $26. That history gets reported to the credit bureaus. Why I recommend this one is it's a guaranteed loan. It's a guaranteed approval. We don't pull credit because we have, if you don't pay the loan, we're just going to take the money out of your savings. So there's no risk to us. So share secured installment loan, guaranteed approval. And because I know the game now, so if you applied at California Coast Credit Union, I did the loan today, I would want my first payment due October 31st. So that November 1st, I get a payment reported to the credit bureaus. Once I've got 6 payments reported, now I've got a credit score and I can apply for a regular credit card. There is an option on here, share secured credit card. I'm not a fan because with a share secured credit card, you typically have to put a little aside. They hold it the entire time. And then once you get a regular credit card, they close that one. So you're going to lose the length of credit history. I would rather do the share secured installment loan, do 6 payments, not have my credit pulled, and then 6 months later, get a regular credit card because now I'm going to build my credit history a little bit faster. So I'm not a big fan of share secured credit cards. I prefer the installment loan. It's a much lower interest rate. And then as you pay the loan off, we release the hold on that dollar amount. So I like the share secured installment loan. Then once you've got a regular credit card, you use payoff, use payoff, use payoff. Just keep doing that. Once you've got 6 payments reported, apply for 2 more credit cards. That's how I build people to within 2 years having a credit score above 700. Share secured installment loan, authorized user, Experian Boost, 6 payments reported, get a regular credit card, 6 payments. A year later, I get 2 more credit cards. I just use payoff, and we can get that credit score above 700. Building credit is pay your bills on time every month. Never be late because it takes 2 years to recover from it. Don't even charge more than 30% of your credit limit. Don't ever go over it because it's 15 to 20 points on your score. Use your open credit cards at least once every 6 months. Don't close out the credit cards you've had the longest. Spend less than you make. This is the important part. Don't rely on credit cards to buy tires. You have to buy tires. Don't rely on credit cards to buy a cell phone or a computer, because we know that those are expenses that are part of our lives. Save some money, set it aside so that when I need to go buy tires, I charge it to my points credit card. I go straight home, I pay off what I just charged. So I want you to save in accounts so that you're saving up for the things we typically put on credit cards. So I can use the credit cards, pay them off, use the credit cards. Don't let them use you by carrying balances over and paying high interest. All right. So we learned about what affects your score. We learned about how to manage credit score, how to build that positive history. So on this webinar, we are going to have this link for you about the Enrich, which has all of those great tools that Josh was talking about. There's articles, there's courses, there's videos, really great information on there. You can also go to our YouTube channel and you're going to see a wealth of our previous webinars that we've done. We do those recordings and we put them on our YouTube page. And then if you want to set up a one-on-one credit review, this is a free service we offer as a benefit of membership with CalCoast. If you want to sit down and go over your credit report one-on-one and get step-by-step instructions on how to improve your credit score, send me an email, send Jevin an email. He's our other CalCoast financial fitness coach. We are happy to schedule us 1 hour. We can tell you everything you need to know as a free benefit of membership with the credit union. So questions? Hopefully we took some of the mystery out, right? Hopefully we answered all those questions that pop up. I answered all questions. My good. This is a good webinar then. We covered all the questions. You can unmute, you can chat however you want. Awesome.
Thank you so much, Terry-Lynn. I think we'll give everyone just a second to formulate any questions they might have. And in the meantime, just want to thank you again for all this this wealth of information. It's a lot of info that I say this every time. I always learn something new every time I see you present, even though I've seen it before. So it's really great. And I'll mention again that we have all kinds of resources available to you. So visit the link that's in the chat. It's especially made for you as City of San employees. There's all kinds of tools and resources there to answer any questions you might have about credit or anything else related to finances. Or, of course, you can work with Terry-Lynn and Jevin anytime. And also just want to let you know that we are doing these webinars monthly. So our next webinar will be in November. It'll be on the 18th at noon. We're going to talk about long-term care. So be on the lookout for that email to hit your inbox with the invite. And you can register for a session for November. Any questions? All I'm saying is thank you. This was great. Terry-Lynn, you're getting all the praise that you deserve as usual.
One of my favorite topics. How do lenders view student loans? Ooh, that's a good one. Student loans impact your credit score just as much as any other type of loan. You borrowed the money and we do expect you to pay it back. So late payments, this is one of those ones I see a lot that people forget that it's coming out of deferment or coming out of forbearance and they get these late payments. That hits your score just as much as any other type of loan. So, stay on top of that, note when it's supposed to come out and contact that lender a few months before. A lot of our loans have been in deferment for the past year and a half due to COVID. January it's supposed to be coming out. So just stay on top of that. Reach out if you still need assistance. Talk to your student loan provider to talk about the other options they have available. If you need to continue deferring, going to forbearance, income-based repayment, public service, all types of options available, but do stay on top of your student loans because those balances do impact you. So if you're, went for your PhD and you've got 20 student loans and you owe $100,000, that is impacting your credit score because that's a lot of money to owe to the federal government. So yeah, those balances do impact you. Payment history impacts you. All of that impacts you like any other loan does.
All right. And then, Darren, I think you were going to ask a question. You're still there?
Lost him.
Yeah. So, hi. Thank you. I'm in the middle of trying to purchase a home, and the lender I spoke to suggested I do not pay off any of my credit cards at the moment. Go ahead and if they have a balance on it, keep the balance on it for now. Continue to make the payment on it, but don't actually pay it off. What's your opinion
horrible. That is horrible advice. Okay. If you have a balance on that credit card, that minimum payment is impacting your debt to income ratio and impacting your credit score. So that is horrible advice. And that's where you get that misinformation about people think you have to have balances on your credit cards because that shows that you're using your credit. No, that we want zero balances on your credit cards, and that way that minimum payment's not impacting your debt to income ratio. You're going to qualify for more, and your credit score is going to be higher. I saw a $10 balance on a $10,000 credit card that got reported because the woman didn't pay it off before the reporting date. Her score went down a few points. So any balance at all is costing you points. And I can see as a lender that you had a payment last month. So if that's what we're worried about is how you're handling credit today, I'm going to see as a lender that you've used that credit card recently by that last payment made when I pull your credit report. So that is horrible advice. And this is why I do this. This is why I love this so much, because that's the misinformation that's out there. You do not want to have balances. To get the most points, if you have Credit Karma, right underneath the name of the lender tells you when that lender reports. If you have Experian, in the information about the loan, when you click on the drop down arrow to get all the payment history information, it says balance updated, balance on, balance as of, balance reported. That's the wording that you're looking for. Look at the reporting date, get those paid off. You're going to see your score go up, and that your debt to income ratio will go down.
Okay, great. I also, my student loan was recently fell off of my credit, and my credit score dropped a little bit from that. How do is there any way to get those credit scores back from that falling off?
No, because variety of debt, remember, so your score is based on what you've done in 2 years. So if you paid off those student loans, they stay on the report for 10 years and then they drop off, and you're never going to see it again. So that's where that length of credit history comes into play. You pay off any of those installment loans, it will fall off your report, which is why I'm so scared that JCPenney is going to close, because that's my oldest credit card I've had for 25 years. They're right around the corner of closing, and I'm going to lose that history once it falls off in 10 years. And that's 35 years worth of history. Student loans typically have a much longer repayment history. So that length of credit history, which is 15% of your score, was impacted when that fell off. So there's nothing you can do except, create more variety of debt. But if you're in the process of applying, don't get any new loans, because that can stop you from getting the house just right there. Like, why are you applying for new debt when you're getting ready to buy a house? I don't know. I've actually seen real estate loans get denied. They got approved, pre-approved, and they got 2 new credit cards, and then they got denied because they have these 2 new loans on there. So you don't want to make any changes on the number of debts that you have. It's just, now that you know this going forward, don't close the oldest credit cards that you have, and just understand that that stuff does fall off.
Okay, great. Well, and so I just broke my phone and I need a new phone. Is it better just to buy one outright, or go ahead and do the credit?
Buy it outright. Don't add any balances to your creditors. Again, pay off what you have and don't add any balances. Or they have those. I'm not a big fan of doing $1,000 phone over 3 years and increasing my cell phone bill by $36. This is where we talk about saving up the money. You're going to replace that phone in 2 or 3 years. Set aside $20 a month into an account so that the next time it comes around, you've got the money for it and aren't relying on credit. I would not charge it. I would pay cash for it if you can, and I would pay off all your credit cards.
Great, thank you.
Yeah.
Carolyn, if Darren were to decide to get the phone and put it on the cell phone bill, that wouldn't necessarily affect anything in regards to getting a home loan, right? I don't think that would necessarily be reported or change anything, right?
Unless they're doing so. If they apply for Experian Boost, so this is one thing with the Experian Boost, they're putting that payment on your cell phone, on your water bill, SDG&E, Netflix, Disney. They are putting that information on the Experian report. So that payment is going to impact the debt to income ratio. So if you apply for a car loan, or it is going to impact that debt to income ratio. But it's a service that you're paying for. So typically, services that you pay for, the cell phone, SDG&E, utilities, typically that doesn't get reported. So if your cell phone bill goes up, that's not going to impact, and it's not reported, that's not going to impact anything.
And I think you're spot on about the paying off the debt. I don't see any reason you couldn't pay it down, unless maybe you wouldn't need to have that money for the down payment on the home loan. But
that might be, yeah.
Yeah, it's interesting that a lender would say don't pay it off. If your score is going to increase, maybe they're just trying to get more interest, trying to keep your interest rate up or something. It seems kind of backwards. But I know in my experience, they'll say, hey, don't make any large purchases. Don't go out and spend $5,000 on your credit card or something like that, because then that'll negatively affect it for sure. But yeah, it's interesting that they would not want the credit card to be paid off.
The only thing I can think of is what you said, where they're using that asset to get them approved as collateral or something. And if they take it out, now they're not going to qualify. That's the only thing I can think of. But credit score wise, you want them paid off.
All right. Well, a lot of great questions. We're over time here, so I think we'll, in respect to everyone's time, we'll let you go. But again, if you have any questions at all, you can contact us in so many different ways. Online, email, phone. You can contact Carolyn or Jevin directly. Their info is on the screen here. We're always here to help you out. We want everyone to be financially well. That is our mission. And so we are here to help you achieve financial wellness. So contact us anytime. But in the meantime, we'll say goodbye for now, and we'll see you at our next webinar. Thank you for joining us, everyone.
Bye, everybody.